If your idea of an investment is to find a stock tip, buy the stock and make a quick profit and then sell the stock, then you're wasting your time watching this video. However, if you would like to be able to understand how to evaluate the actual operating performance of a business, then you'll be very pleased that you spent the next few minutes watching this video. I'm going to share with you some insights which can help you to separate a good business from bad ones. I'm sure you all have heard about these terms: return on assets, return on equity, or return on invested capital. That's ROIC. But how do you calculate these? And more importantly, what do they stand for? What do they signify? Now, I know for many of you, return on assets, return on equity, these are terms that you're very familiar with, but I would still encourage you to watch on because I will be highlighting some nuances which maybe you haven't come across in the past. Now, whether the value of your investments in the long run reach here or they reach here, that depends on the return on capital and of course the entry price when you purchase a stock. But the interesting fact is, the longer your holding period is, the larger is the effect of that return on capital compared to the entry price. Of course, you should never buy a stock above its intrinsic value. You should always pay a price that's below its intrinsic value. Let's start with the return on assets. In any business, the value is added on the asset side of the balance sheet. The liability side basically captures how these assets have been funded. Now, return on assets tells us how much net profit a business is able to generate using the total assets on its balance sheet. It indicates how efficiently the management is using the economic resources on the balance sheet. Now, for calculating the ROA, we use average assets, that is average of the beginning and the ending assets. And this is because the total assets on the balance sheet, they vary over the financial year. So the return on assets is expressed as the net income generated by the business in a financial year as a percentage of the average assets. So basically, for every dollar of asset on the balance sheet, how much net income is the company generating? If there is one single ratio that every shareholder should know about in analyzing the profitability of a business, it should be none other than the return on equity. So next we come to the return on equity. Now, this is arguably the most important formula in business finance. This is the ratio that tells us how the shareholders' capital will be compounded over time. Now, ROE is the profitability ratio that tells us how much net profit a business is able to generate for the common shareholders. And this is calculated by dividing the net income by the net shareholders' equity. It basically indicates how much net income the business generates for every dollar of shareholders' equity. And here also we use the average total equity for this calculation because the equity varies over the year. The retained earnings increase the equity, and when the business gives out a dividend or buys back share, that decreases the equity. So we use the average equity for the entire financial year. So if a business is able to maintain a high ROE, that would indicate that the business is being able to invest its retained earnings in an efficient manner. Whereas if the ROE of the business is going down over time, that means the business is not being able to generate a commensurate return on the internally generated capital, which is the retained earnings. And if that return falls below the cost of that capital, then it would mean that the management is actually destroying value for the owners. So the owners of the business are better off getting the earnings sent out to them as dividends instead of being reinvested further in that business. And you remember we talked about cost of capital? Now that is basically the opportunity cost of the capital. Simply means that if that capital could have been invested elsewhere in an investment with similar risk, the return of the alternative investment would generate, that is called the cost of capital. So here I just take a simple example where I show the liability side of the balance sheet, but the total assets equal to the total liabilities. And let's assume the business has a debt of $5 million and an average equity of $15 million. So the average total liabilities is $20 million. Here we are just ignoring the operating liabilities for the sake of this example. If the business generates a net profit of $3 million, so the return on asset is at $3 million over $20 million, which is 15%. And the return on equity is $3 million over $15 million of average equity. So the return on equity is 20%. So as you can understand, the quantum of the debt on a balance sheet acts in enhancing the return on equity over and above the return on asset, because the debt helps the business to control more assets than what the equity would allow. And businesses with low or no debt, the return on equity figure will be much closer to the return on asset figure. So businesses often try to boost their return on equity numbers by using a lot of debt. Now, this is not healthy, and our preference would be businesses that generate a high ROE without employing a lot of debt. That is purely by virtue of being more efficient. Now, I can give you a few other examples why even without any debt, the return on equity can be materially higher than the return on assets. Now, imagine a business often has other sources of funding. And here I'm talking of operating funding, which are not interest bearing. For example, accounts payables or tax liabilities. A good example would be a business which runs on a negative working capital. What does that mean? Which means the business is collecting its revenues much faster than the time it takes to pay its suppliers. And it does not carry too much of inventory. So typically, you have these platform businesses which run on negative working capital. So basically the suppliers become a source of funding, right? So that allows the business to control more assets than what the equity capital would be able to control. Same happens when a business has large deferred tax liabilities. Why does that happen? Let's say the business has some unrealized investments, so basically some unrealized profits on which the tax is yet to be paid, because the tax is typically paid when the profits are realized. So that causes a deferred tax liability. Berkshire Hathaway would be a great example of a business with a lot of deferred tax liabilities. This is because of the large amount of unrealized gains on which the tax is yet to be paid. So essentially, the tax department of the government is partially funding the assets of the business. Now, these are all interest-free sources of funding, and in these cases, these sources of funding allow the business to control more assets than their equity, as we said. And that is the reason why we would typically see the ROE figure to be higher than the ROA figure, even if the business does not have any debt. Now, this would be a good time to pause the video and get yourself another cup of coffee, because the next concept which I'm going to discuss is very important, and a lot of future valuation related discussions will be much better understood if you understand this concept. So this is the concept of an unlevered firm. Now, for a business, the return on assets indicates the profitability that the firm achieves on its entire assets. And this is irrespective of how the assets have been financed, whether a combination of debt or equity, or whether it's only equity. So to understand this metric, it should not be affected by the cost of the debt. That is the interest expense. Therefore, we do something that is called unlevering. We unlever the business by assuming that there is no debt on the balance sheet. Now, this helps us to compare the profitability of two similar businesses, two businesses in the same industry, without letting it be affected by the financing structure. So to do that, we need to take out the effect of the debt on the net income figure. And let's see how the net income figure has got affected by the debt. Now, there are two ways in which it has got affected. Number one, we have to take out the interest expense, which has reduced the net income figure. However, you have to understand that we cannot just add back the entire interest expense to the net income, because you would remember that the interest expense was deducted from the EBIT, or the operating profit, to arrive at the profit before tax, which means the total tax payable also got reduced due to that interest expense, right? So we need to also take into consideration that reduction of tax, or what is also called as the tax shield, due to the interest expense. To consider what was the after-tax interest expense, we need to also adjust for this tax shield. So we take the total interest expense and subtract the tax shield from it. And as we have seen earlier, the tax shield is the interest multiplied by the tax rate. So the after-tax interest expense becomes 1 minus tax rate multiplied by interest expense. Now, I would suggest pause the video here and think about this concept a bit, because this concept will be very useful in future. So let's look at this example. So this business generates a revenue of $1 million. Now, I'm right now referring to the left side of the screen. Its gross profit is $500,000. So we are assuming that it has a gross profit margin of 50%. It has operating expenses of $150,000. So the operating profit becomes $350,000. So the operating profit, or the EBIT, is $350,000, translating into an EBIT margin of 35%. Now, the business has some debt, and because of that, it incurs interest expense of $20,000. Now, this interest expense is tax deductible. What does that mean? You subtract the interest expense from the operating profit of $350,000 to arrive at the profit before tax of $330,000, and then you apply the tax provision. I have assumed 25% tax rate. So you apply the tax provision of 25% on that PBT of $330,000 to get a tax provision of $82,500. So the business has to pay a tax of $82,500 to the government. And After doing that, the net profit is basically 330,000 minus the 82,500, which results in a net profit of 247,500. Now, let's unlever the same firm, which means let's now look at the same P&L, assuming that the business does not have any debt, or maybe the business has paid off its debt. So here, the EBIT still remains $350,000, but after that, there is no interest expense. So the tax rate needs to be applied on a PBT of $350,000. So here, basically, the profit before tax is same as the operating profit. And here, the tax provision is 25% of that, which is 87,500. So that results in a net profit of 262,500. So you can see that the difference between the left side and the right side is a $5,000 of tax difference. The interest expense of $20,000 on the left enjoys a tax shield of the interest multiplied by tax rate, which is $5,000. $20,000 multiplied by 25%, which is $5,000. And that is the difference between the two tax provisions. So without the interest expense, that is in case of the unlevered firm, the difference in the net profit works out to $15,000, which is nothing but the interest expense of 20,000 multiplied by 1 minus 25% or 0.25. So that's how there is a $15,000 difference between the leveraged firm and the unlevered firm. This concept of unlevered firm leads us to the term Nopat. You would hear it often, or you would see this in many analyst reports. Nopat stands for the net operating profit after tax. So first, you need to think as if the business does not have any debt, and Nopat is basically a measure of the profit that excludes the costs and tax benefits of the debt financing. It is basically the earnings before interest and tax after adjusting for the taxes. Now, why does this matter? The Nopat uses only the operating income before any interest expenses are deducted. So the Nopat gives a very good idea of how efficient the operations of the business is, and it is not contaminated by the financing structure of the business. This is important because those interest payments on debt, they reduce the net income, and they also reduce the company's tax expense, as we have seen. Thus, Nopat simply looks at how well a company's core operations did, net of taxes, assuming there was no tax shield from that interest expense, because there was no interest expense. Now, this is a good way to compare between the operations of two different businesses in the same industry and does not give any extra points to a business which is using a better financing structure. Putting everything together in the same example, we see that in the unlevered business, it has a Nopat of 262,500, and there is no interest expense or tax shield here. Let's assume the business has a debt of $300,000 and an average equity of $1.5 million. So the business has employed a total capital of $1.8 million. So the return on invested capital is nothing but the Nopat over the capital employed in the business, which is Nopat divided by debt plus equity. So here it is 262,500 divided by 1.8 million expressed in percentage, which amounts to 14.6%. Now, return on invested capital is again a very important metric, and if you have read or listened to Warren Buffett, you'll hear him talk about this a lot, because it is this return on invested capital that decides whether the management is adding value to the shareholders or the management is destroying value. So it's very important for this return on invested capital to be higher than the opportunity cost of this capital. Now, here you would notice that we have assumed that the entire capital, that is the debt plus equity, is invested in the operating business. However, sometimes businesses sit on a pile of cash and they may not be investing the entire debt plus equity in running the operations of the business. So here I introduce you to another formula to calculate the return on invested capital, and we actually use this formula, this method much often, and that is we use the working capital plus the property, plant and equipment and the intangible assets as a proxy for the capital that has gone into running the operations of the business. The business could be sitting on a cash balance of $400,000, which is not being used in the business. It might be sitting in some short-term investment or in a bank deposit. So to calculate the actual return on the invested capital, we take only that part of the capital which is used in the business. So using the same method, we arrive at a return on invested capital of $262,500 over $1.4 million, which is 18.75. So to summarize, here what we have done is we have looked at the total amount of capital that has actually been invested in running the operations of the business, and not the part of the capital that has been used in external investments or sitting in a bank deposit. So we see how efficiently is that capital which is running the operations, how efficiently the management is using that capital. And the Nopat takes into consideration the after-tax operating profit that the business is generating. So here again, we do not worry about the financing structure of the business. The financing structure of the business can change from year to year, or some other owner might come and acquire the business and just pay off the debt. So to really evaluate how well the operating business is doing using the capital which has gone into the operations, the ROIC is a great metric. So now you have seen how to calculate these operating performance parameters of a business. And we typically look for businesses with high ROE and high ROIC. There is no hard and fast rule, but my preference would be to look for businesses with an ROE figure of at least 15%. Now, even after meeting these conditions, there could be hidden risks lurking elsewhere in a business. And it's also important to understand those risks. So I have got you covered there. I have created a 6-part video series where I have discussed different types of risks that could be there in a business, and watching these videos can really serve you well to understand these risks. And it actually doesn't take too much time to uncover these risks. Maybe just a few minutes is all you need to see if the business scores well in even those parameters.
If you found this video interesting, then you should definitely join our research platform. It's completely free to join. There are no hidden costs. And that's where we publish our free research on several high quality businesses, which are typically compounders. The link to join is available in the description section below. And I also welcome you to join our Facebook group called the Investment Forum. That's a place where we discuss these high quality businesses with several other DIY serious investors. And you will benefit from the discussion, I'm pretty sure. And if you enjoyed this video, can I please request you to hit the like button and do subscribe to our channel. It does not cost you a penny, but it'll really help us with the YouTube algorithm. And we will be able to notify you whenever we are coming up with other interesting videos on company research or other investment concepts. So I'll see you in the next video. Thank you very much for your time.